Hi everyone, in this video I'm going to do a brief review of DoorDash's third quarter earnings results, so let's get right into it. DoorDash is slowing down from its rapid growth during the earlier stages of the pandemic, but that's understandable. Of course, it's not going to grow as fast as it was during times when restaurants were closed and people were ordering food for delivery more often. Overall revenue still increased by 33% in the third quarter to 1.7 billion. The net loss of 296 million was almost triple the net loss of 101 million last year. And that's been the theme with these food delivery and rideshare companies, is that they're just losing massive amounts of money on the bottom line in the efforts to grow their business on the top line. If they were to raise prices enough to be at least break even on the bottom line, who knows how much their business would slow down. Gross marketplace orders increased by 30% to 13.5 billion. This was up 25% in from the previous this was up from a 25% growth rate from the previous two quarters. That means it's accelerating, which is good news for DoorDash. However, excluding the impacts of an acquisition, gross order volume actually only increased by 21% year over year. Now, these gross order volumes are important because this is the base from which DoorDash takes its fees off of, right? When you order something for $20 on DoorDash, DoorDash doesn't keep the entire $20. It takes a percentage of that as its fee. And so the higher those orders go, the higher DoorDash fees can be. And so that take rate, which is the amount DoorDash takes from the total revenue, increased to 12.6%, which was up from 12.2% in the same quarter the prior year. And this has been the case with, this was the case with Uber. They also increased their take rate. And it's been the case with several companies that I follow that make money in this way, where they take a percentage of the total order value. Even e-commerce companies like eBay and Etsy have been doing this, where they're increasing the percentage that they're taking for themselves. And that's coming at the expense of their sellers on the platform. But this has been a trend through all of these platform as a service companies are increasing their take rates, and that's helping boost their revenues as the actual order volume growth is slowing down. The DoorDash is expanding from just a food delivery company. Now they want to become a delivery company, a fast speed delivery company when you want something delivered to your home in an hour or less. And so the restaurant contribution margin is funding the rest of the business area's growth. The restaurant delivery business is positive in terms of contribution profit, but the rest of its business is not. So gross order volume from non-restaurants increased 80% organically year over year. Some major deals in that space include Dick's Sporting Goods, Tractor Supply Company, and Big Lots. So as they add new partners, non-food delivery partners, that's going to expand the type of orders customers make. Instead of going to DoorDash just for food delivery, you go to DoorDash for other things that you might want delivered to you in a hurry. Overall, cash flow from operations of 344 million in the 9 months ended September 30th was down from 525 million during the same time the prior year. The company is able to operate on a positive cash flow, but still generates negative net income on the bottom line because it uses a significant portion of stock-based compensation. Instead of paying its employees in cash, it pays a lot of its employees in stock-based compensation. And so it's positive cash flow because that's not cash that's outgoing, but it's still positive for the company's cash balance. However, this has the side effect of diluting shareholders. That means when they do eventually become profitable, shareholders are going to have to split those profits among a wider base. So your earnings per share is getting diluted and decreased, even though right now it appears like, oh, look at this company's got positive cash flow from operations. That's a near term effect. Longer term, the cash flow from operations, the fact that the bifurcation between the net loss and the cash flow from operations will come into balance in the longer term. So overall, solid quarter from DoorDash. The fact that it's still growing order volume, even though the economy is already reopened and restaurants are reopened, the fact that it's sustaining this elevated level of business is great news for investors. However, I personally would like to see the company raise its prices to a level where it's not losing so much money on the bottom line. I would like to see all of these companies raise their prices to a level where they're not losing so much money on the bottom line. Then we can evaluate them on a sustainable basis and see how much customers they got, how much revenue they got when they're not actually subsidizing each order by lowering the price a significant degree. All right, that's all I've got for DoorDash earnings update. If you've gained some value from this review, please go ahead and hit the like and subscribe button. It'll help me make videos like this one. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.